didn't even ask. I just went on.
Okay. Antonella, does it say it's recording for you?
Yeah, it says so.
Okay. So, okay. Can you see my screen?
I can see your screen and I can see you too as well.
Okay, great. Fine. So I'll just start over from the beginning. We're going to go over the Music Box's budgeting case. Here you can see their projected sales for the next 5 months, as well as the projected prices. You can notice how the price starts to go down in the holiday season and dips even further in order to liquidate their inventory.
Mm-hmm.
Again, this is projected or like predicted versus actual. So Music Boxes has historically collected 20% of sales in cash at the time of sale, as they offer a 5% discount. So if you were to figure out the cash sales within a month, you would do 20% times 95% because that reflects the 5% discount. You see?
Mm-hmm.
And that's happening in a month. And then of the remaining 80% of sales on credit, 40% is collected in the month after the sale, and 60% is collected 2 months after the sale. So here you have a 1 month delay, and here's the 2 month delay. Again, of the remaining 80%, 40% has a 1 month delay. And then of the remaining
You have to go slower. You have to go way slower. Wait, you have to wait. Look at me, like wait for me to process that information, and then we can go on.
I can't see your faces, so just tell me when to stop.
Yeah, so pause. Give me 1 second. Let me write this down.
That's the one thing. Whenever you share your screen, you like can't see the faces of the people you're talking to. And it's like I can't see if you're like completely perplexed or not.
Okay, I'm a bit perplexed. Give me a second.
For the first one, for the in month, you did 20% times what?
I did 20% times 95% because that reflects a 5% discount. I could have also done 20% times 1 minus 5%, but that equates 95%.
Okay.
What does it mean collected 20% of sales in cash at the time of sale as they offer a 5% cash discount? So when you use cash, like at this store, they give you a 5% discount?
Correct.
But what does it mean collected 20% of, and then they also reduce it by 20, they have like a sale going on, so it's 20% of the whatever the value is?
No. So 20% of their customers pay in cash.
Okay. Okay, I got it. We can move on.
And then the remaining 80% paying credit, and then the credit card companies pay the Music Box company. 40% of them pay 1 month later, and 60% pay 2 months later.
Okay. Do you know if this is real? Like they usually take like a month or two to collect money on credit cards.
Right. So this entire problem is a question of cash flows, not income statement items, because income statement tells you how much you earned or spent in a month, not how much you collected or paid in a month. And there's a difference between those two sets. Because one is about like when the thing happened in terms of like when you made a sale, and the other thing is like when you actually got the cash.
Okay, interesting.
So moving forward, the rest of this stuff I'll kind of go over quickly because we'll reference back to it once we actually go through the questions. So Music Boxes purchases a product from a Swiss manufacturer. Due to logistics risks, Music Boxes inventory policy is to have the next 2 months of sales in units and ending inventory at each month end. A red flag you might have in your head is what if you don't meet the next 2 months sales? Like you don't necessarily have to have 2 months in ending inventory. Why not just carry 1 month in ending inventory? That's something you can like think about. And then here, Music Boxes has 6,000 units in inventory at the end of September. Again, you need that for the question moving forward. Music Boxes pays the Swiss manufacturer 30 days after receipt of goods. Each music box costs $18. September purchases were $72,000. You need this just to answer the question, so you don't really have to remember it. Music boxes incurs variable SG&A expense each month, 10% for commissions on gross sales. In addition, a fixed monthly SG&A expense of $25,000, including $3,000 of depreciation expense, which gives you a net $22,000 monthly for the SG&A expense. That's
Okay,
these two things.
give me 1 second. Let me write that down.
This is 22.
Okay.
So this will be a separate line. Like they didn't combine all of SG&A into one line. They ultimately put commissions and SG&A as separate. But so what we're going to do is we're going to figure out what cash we have coming in and what cash we have going out. That way we can make a cash flow statement. It's pretty simple. Like I swear. So here you have the same template copied from the previous tab, and they just did a multiplication to get sales. Okay. But that's income statement relevant because that's how many sales you had in the month, but it's not the amount of cash you collected in the month. So now we're going to figure out the cash you actually collected. So they told us that 20% of the sale is collected in cash, and they subtracted a 5% discount, and this is your cash collections.
Okay.
You could have also done that by just
How come
multiplying by 19. Because remember, this is the 20% times 0.95. I also summarized this thing from the previous tab.
Wow. Okay.
So if you wanted to use the shortcut from the previous tab down here, which I think is the better thing to do, you would have just multiplied the 60,000 times 19 to get the in-month cash collection. I'm just going to plug in my laptop real fast. That way I don't die mid-presentation here. In number 2, they're comparing the actual collection of cash to when the sale happened. So like, it's kind of weird and confusing, but basically like November sales, if you added this row, or let's say October sales, because that's the one with the full 3 across. If you added all 3 of these up, it should add up to 99% of 60,000. And the reason why it won't add up to 100% is because of that cash discount.
What did you say again? Say that one more time.
October sales, if you added these across, this is October cash collection, October credit 1, and then October credit 2. If you added them together, it would add up to 99% of $60,000.
Oh, okay.
And it won't add up to 100 because this has a cash discount. The problem gets a little tricky with these 3. Just a little bit, just enough to trip you up. All this stuff makes perfect sense. Like if you see this is just the $60,000 times 32, this is the $60,000 times the 48, because these numbers include multiplying 80% by 60% or 80% by 40%, as the question showed. Remember when I made this little chart on the previous tab?
Mm-hmm.
These ones are a little complicated because they already give you August in credit. So you don't have to take the 80%. You just have to multiply it by 60 or 40. So because this is already in credit, you don't need to multiply 80% because it's not the total. They already gave it to you in credit. So you're just going to take 60% of this for the 2-month delay and 40% of this for the 1-month delay, because this is September credit sales. See, this is why I don't like this whole organization thing over here, because it like doesn't make sense. but this is given to you in the question.
Can we go back up to the question?
Where is it? Right, so August and September credit sales were $30,000 and $36,000 respectively. It's that part. That's what they're talking about here. There's no room to put it in this, which is why I don't like how they organized it.
Oh, okay.
So they just multiplied it by 0.4 and 0.6. These are the only funky ones, is these three. These ones are much more straightforward because you're just going to use your shortcuts from over here.
But wait, the 60% and the 40%, that was given in the question too?
Yep.
Oh, okay.
Yeah, and that's what we incorporated over here into these shortcuts.
Yeah.
So then you add it all together, and these are your cash collections. So this is your cash in. So if you compare it to the income statement relevant part, it's kind of, I don't know, it's not what you expect. Like, let's put it that way, right? Because you earned $60,000 in October, but you only collected $43,800. You earned 120 in November, but you only collected just over half of that. You know, same here. So it's just kind of like, what the heck? This is going to end up going into the bottom once we make the cash flow statement, and that's why it says cash flow statement relevant. Mm-hmm. This part is going to deal with your purchases and the inventory stuff. So if you remember how they said we're going to take the next 2 months sales and have it as our ending inventory, that's how they did this. I'm actually going to copy some stuff from the top. Oops. What is this? Does this have text in it? No. January 2000, 2,500. You just need these two numbers in order to figure out these. So again, you have the sales bar. This is given to you, this sales thing. So I'll just write given. And then this is the line you're actually solving for. Because if you think about it, your ending inventory, right? The next 2 months projected sales, your ending inventory in October is your beginning inventory in November. So that just carries up like that. So it's really simple. The only thing you have to solve for is the purchasing line.
How did we go from September 4,000 purchases and then 6,000 in inventory?
This you solved for by going backwards, but they gave you this. They told you that September's ending inventory is 6,000 units.
Uh-huh.
So that means that's your beginning October.
Okay. So they'll give you purchases?
They won't give you this.
So then from September, how are you supposed to figure? Okay. I don't know how we got 4,000. That's the question I'm trying to ask for.
I'll show you. So basically, ending inventory for September. You should be able to figure that out, even though they told you outright. But it's these two numbers added together because it's the next 2 months, right? This becomes your beginning inventory. And then you have these three numbers. You're just solving for the 8,000. And what you notice is that 8,000 that you purchased in October is what you ultimately should be selling in December.
Mm-hmm.
So therefore, you notice a pattern going backwards that this 4,000 comes from here.
I would have never figured that out.
Always look for the pattern. See it? Just take it all in.
Yeah, give me a second. Do you get it, Antonella?
Okay, what did you
Do
say?
you get how they got 4,000 for purchases?
Well, like, if she hadn't explained it, I wouldn't have figured it out.
Can you re-explain it? I don't get it. I still don't get it.
We'll put it this way. Let's just figure out purchases for October 1st, okay?
Okay.
So again, this number came from over here. This number is these two numbers added together. You know, this is given to you because this sales bar is your projected sales. So you know where 3 of the 4 numbers are coming from, and then you just have to solve. So you're like, 6,000 plus X minus 2,000 needs to equal 12,000. So you just solve for X.
Okay, yeah, I get it. Yeah. Okay.
So that's 14 minus 2 gets you to 12.
Yes.
That's how you solve for this one.
Okay.
You do that all the way through, right? But then what you notice is that this 8,000 is here. This 2,000 ends up coming out here, and this 500 comes here, and all that. So you notice a pattern forming, and that's how you realize that it's 4,000 back here.
Okay.
Okay.
And you need to see that pattern because when you get down to number 4 with the cash payments, and you're multiplying the units by the price to purchase the unit, so it's $18 per unit for the music boxes, like for the company, to buy them from the manufacturer. You end up paying that in October. That's why you need to know how many purchases you had in September, according to this pattern, because what ends up happening is that number times 18, you pay it 30 days later in October.
Okay.
So this is your payments. Again, cash flow relevant. So this is cash out. See the difference between spent and paid?
Mm-hmm.
So this here drop down to here.
Okay.
Because you're trying to figure out the purchases you made, how much they cost, and then when you actually pay them. Does that make sense?
Yes.
This one is pretty easy. I think you guys got that one. This one is about patterns. You just have to solve for X and then figure out the pattern to get this one. This one is really easy. You're just going to take this line, multiply it by the price per unit, and then delay it 1 month because that's the timing. And then here you just put everything together that you already had from above. So they tell you that your beginning cash balance in October is 200,000. They tell you that over here.
So for number 4, what would be or for number 3, I mean, what would be the official answer that you would put?
They're saying what are the purchases in units?
What are the cash, or wait, for 4, what are the cash payments for October? So
your cash payments for October is 72, for November 144, and for December 30.
Okay.
Payments, not spending.
Okay.
Here, you'll see that the cash receipt line is directly copied from above. So this 43.8 and 63.6, that came from here. And that's your cash in for the cash flow statement. You just add them across to get the quarter.
Mm-hmm.
Your cash disbursements comes from number 4. So that's this right here.
Mm-hmm.
Sales commissions is 10% of the sales you made that month. So this is just 10% of projected sales.
Mm-hmm.
And then the SG&A is 22 all across.
Mm-hmm.
So you go from your beginning cash balance, which they tell you, like I said, you add the cash in, subtract these cash outs, and then you end up here. Again, October end is November beginning, so you move that number up here. Do the same thing again. You get to this point, move that number up here, same thing again. And then where you end up at the end of December, that's the end of the quarter. So this is your beginning of the quarter is the beginning of October. End of the quarter is the beginning of December. Those are the same. And then all this stuff in the middle, you just summed it across.
Okay.
This whole problem should be on your cheat sheet.
Okay.
But like I put little notes for you, like this came from question 2, this came from question 4, and these 2 things are given.
Okay.
I can email this to you once we're done.
Okay.
Here you have variance analysis. This seems ugly and complicated, but it's actually really easy. It's just comparing actual to the budgeted. So this is the budgeted, and it comes from above. Like you expect to sell 2,000 units in October at $30, but in all actuality, you ended up selling 100 extra units and for $1 less. This made you $900 more just via multiplication. And if you were to subtract, you know, the budget from the actual, that's how you see that you made $900 extra.
Okay.
So the language here, October budget under applied by $900. I think it's just easier to say that, you know, our October budget was this. We actually made this, which means we made $900 extra, which is good. Does that make sense? Should I continue?
Isn't that kind of bad though that we let go of like 100 pieces of inventory for? Actually, no.
You only sold them at $1 less and overall made $900 extra.
Okay, yeah, you're right.
This B and W is for better and worse.
Okay.
So like 100 extra units, that's good. $1 less, that's bad. $900 extra, that's good overall.
Okay.
I don't know what this is, just ignore that. And then here, this is kind of like a more open response type of question. But the good news is that you can kind of just like memorize a few different solutions because the problems will always sort of be the same. So your cash inflow line, remember this one, that's from the cash credit stuff all added together. This cash outflow line is these 3 added together. So like if I double click this, you see it's F55 through F57. That's these, even though it's a little difficult to see it. That's these ones.
Okay.
So what they're trying to say is like, okay, so the cash we got in for October was this. The cash we let go of was this. So we had a net change in cash of this. So October, November, you're losing cash. In December, yeah, you're getting some cash, but overall for the entire quarter, you have a cash outflow of $141,000.
Okay.
So management has a serious cash flow problem. Management has a serious cash flow problem in October, November. They want to know what your suggestions are for that. So basically, you can reassess credit policies towards customers. You know, can we collect credit any faster? Like, is there a way we can negotiate with credit card companies or maybe only carry the credit cards that pay the fastest? Like refusing people who pay slower. So like say, people who use MasterCard, that credit card company pays us 2 months later. Maybe we'll just stop. Maybe we'll start refusing MasterCard at checkout. Like we'll only accept cash or American Express type of thing. That's why certain companies only accept certain credit cards. It's because of things like this, in addition to the different rates that the credit card company will remove per purchase, because on each purchase that you make, the credit card company is going to collect, say, maybe 3% of the overall purchase.
Is that why like different like retailers offer their own kind of debit card, credit card, because that way they
Yes.
can make money faster?
Yep.
Uh,
Exactly. And then that way, whatever interest that you start accumulating on their credit card, it's just more money for them, even more money for them.
those tricky bitches. No, it's actually really smart. I mean, they're gonna get like the 3% off anyways. So like I know like Target will take away will take 5% off every purchase, but for the most part, they are gonna pay that regardless to another person, like to Visa.
Right. So
Interesting.
if they're not going to pay that 3% to Visa or MasterCard or American Express, they'll actually collect maybe an average of like 8% from interest that accumulates on those credit cards from people who revolve on their payments.
Mm.
It's super interesting. I learned a lot about it while working at American Express, but like that's why. So yeah, you have the right idea. But so other solutions that they could look at is like, can the inventory be sold at even further reduced prices in January and February? So like after the holiday season, like can these things go on sale even further? Or like will that cut into profits and stuff? And then furthermore, can we cut inventory on hand as finished goods? Can we cut that back to 1 month of sales on hand at the end of each month instead of 2 months? Because not only would that reduce cash outflows, like it's saying right here, but it would also cut down on storage costs, which would be awesome.
I have a
Because no
question.
doubt part of that SG&A cost up here, because they just kind of lumped it together, other SG&A, part of this has to be storage. And if you're essentially cutting your storage in half, like that would be really great.
Okay. I have a question for you, Bella. Do you find that like most small businesses have problems with cash inflows and outflows? Because like I would have never known. Like if I were to start my own business, I would have never known any of this.
I think that they're looking at how much money they're earning versus how much money is actually in their bank account. So, yeah, the answer in short is probably yes. But if the business is that small, say it's like a diner or something where they don't have proper management of their accounting and everything like that, maybe they'll only deal in cash, like just period. So, like, you come in, you want to eat there, you have to pay in cash. That's it. Because they don't have time to dedicate to all of this analysis. Like, they can't figure out when their creditors are supposed to be paying them. They can't figure out like all the specifics of it. Because imagine if you do your business entirely in cash, this line right here, this 43.8 would be 60,000. It just simply would be because you don't have these delays happening. You would be getting back everything you make in the sale, which is why people like to do business in cash. Also, they can try to evade taxes if they do their business in cash, but people kind of know if they're a cash only business and therefore they might have like a little bit more surveillance. But yeah.
Okay. Can I walk through the problem with you like one more time? Can we go from like the beginning to end?
Antonella, how are you doing?
I'm good. I'm just trying like to process everything right now because I think like you have to do a lot of steps to get to the end.
Yeah.
So it'd be like a process for like a different process for each step. So I'm trying like to get that in.
Again, make sure that you print this out. I did color code it. So hopefully if you have a color printer at home, like you can follow it a little easy when you're reviewing it. But yeah, so number one, we're trying to figure out how much money we made in sales.
Okay. And then so we do that by units times the price. That's how we get 60,000, 40,000, 4,000 times $30 is 120,000. Continue that across. That's going to be our sales. But that doesn't really mean the same thing as like cash collected because we're dividing it into cash and credit sales. And sometimes the credit cards pay later, right?
Right. So that's number two.
Okay. Yes.
So like October sales all the way across. Like if you were to add this up, like I can just show you real quick. It comes to 59,400. That's 99% of this number.
Mm.
And the reason for that is because this has a 5% cash discount, which overall only gives you 99% of your total sales. But so that means it's correct. But again, this is spanning 3 different months. This is your cash that you got immediately in October, your credit with a 1 month delay, and your credit with a 2 month delay. What we want to know is the timing in month, how much cash we collect. So it's like, okay, we got the 2 month delay credit from August, the 1 month delay credit from September, and the in month cash received for October. And that
okay, I get it now.
Yep.
Wow.
Love an aha moment.
Okay.
So that's our cash in.
Do you know what system people use to track all of this? Is this usually like QuickBooks? Like I don't know what
I can't remember the names for like there's just a name for this type of technology, but yeah, QuickBooks does it. It's enterprise something. Is it EEP? SAS? Something like that. But anyway, so number 3 is just about purchasing in units. I honestly don't know why it says dollars because number 4 gets into the dollars.
Okay. Okay, I think this makes a little bit more sense.
Mm-hmm. Yeah, so you figure out the purchasing in units and then you figure out the payments in dollars.
Okay, I think I will tackle this again tomorrow.
Perfect. Yeah, I really don't think it's so bad. It's a lot at first, but once you review it a second time, like you find that again, like this line came directly from question number 2. This came from question number 4. Both of these were given and you just kind of like slap it together.
Okay. Okay.
The exam will walk you through. Like it won't just be like, okay, so what's the statement of cash flows for the quarter? Like, no. They are going to walk you through all of these parts to get you there.
Okay.
Yeah. So, how are we feeling?
I'm optimistic. I think that this is like we were talking yesterday, me and Antonella, and we have 10 days compared to the 2 days that we usually do when we cram things.
Right.
Right. So like, I don't know. I think that's a little bit stress reliever. So like, at least today, I got an intro to budgeting.
And then we'll go through target costing. I'll show you the end of it because I think when you learn it, it's easier to learn the end and then go back to the beginning.
Mm-hmm.
I guess I can just press stop on this recording. That way this is like a complete thing.
Different thing, yeah.
Yeah.